Welcome back to another quick stock analysis, and today I'll be looking at Tate and Lyle by popular request. Tate and Lyle is a FTSE 250 stock paying a dividend yield of 3.54% and a long-term debt to capital ratio of 32%, which is actually pretty good. One thing we can really see from Tate and Lyle is it's definitely cyclical. Tate and Lyle's got a pretty good current ratio right now at 2.2, 2.3, and it holds it pretty solid, to be honest with you, up and down through the cyclical. In fact, this current ratio is a really good example of the cyclical nature of this stock right now. As far as shares outstanding go, it's pretty flat, which is fair play. Over the past 10 years, I think it's had a growth of around 0.2%, but that's basically nothing really. Revenue over the past 10 years has been an odd one. It's been declining 3.5%, but it has over the past 5 years had a very slow amount of revenue growth. Not anything at all to be excited about though. EBITDA over the past 10 years is declining, pretty flat, but over the past 5 years, again, Tate and Lyle has done something in its business which has led it to become a little bit more profitable. Just for fun, I'm just going to have a quick look at their net profit margin, how that's been changing over the past few years. And over the past 10 years, you can see that their profit margin just doesn't stay stable, and I'd love to know why. Is this really just the cyclical nature of this stock and of this company? The profit margin is kind of all over the place. Next, let's see how much debt they've got, and over the past 10 years, they've been reducing their debt quite heavily. This is very good, and in fact, it says here that Tate and Lyle only have 846 million of debt. I would have thought they would have so much more because they've got that dividend. They're a long company. You think of these yield traps. Maybe this company isn't so bad after all. And what's important with a dividend paying company all the time is this free cash flow. We need to see that it's growing its free cash. At the moment, over the past 10 years, it's been very flat with this massive 800 million in 2010. But recently, in the past 5 years, we have started to see quite considerable growth in the free cash flow. Tate and Lyle hasn't been growing its dividend. It's been very up and down, and you can see why, because of the cash flow. The cash flow is just, well, it's just all over the place. But over the past 5 years, this cash flow growth is very interesting. And to be honest with you, I want to have a quick look in the qualitative section to see why. I think why a lot of people have been asking me about Tate and Lyle is because of this very recent announcement that they're going to divest quite a bit of their company. They're going to spin off quite a lot of their company, or even just split. Tate and Lyle wants to sell off its Sweeteners, which is actually a very large amount of their business. The Sweeteners and the primary product section of their business is very large. It's their bit of the business that they've had for, 100 years or so. So this part of the business is very profitable, it's very cyclical, but it's also not growing at all. It's just literally turning over every couple of years or whatever. So there's a lot to what's going on with Tate and Lyle now. And if we take a look at Tate and Lyle's cash flow graphic, it has a current market cap of 3.76 billion and currently trading at a price to cash flow of 12.76. So this is a company that usually trades at a price to cash flow of 17.73. So this company does have a lot of room to run if it's to go back to its normal, what people would normally consider paying for Tate and Lyle. But for some reason over the past 10 years or so, let's bring it out a little bit. For some reason over the past 10 years or so, it's been pretty flat to negative. If you had bought this stock in 2011, you'd have only made 3.4% a year, and you'd have had a total growth of 2.6%. The dividends definitely saving you there if you're invested in Tate and Lyle. However, analysts do see something happening in 2023. Whether it's to do with this spin-off or not, I'm not sure. Today the price is about £8 a share, and it's jumped up quite heavily, 6% today, just on this news of this breakup. What you're going to have to do is a sum of all parts analysis on Tate and Lyle. Right here you've got food and beverage solutions, which is their new big growth business. That's the bit that's, I don't actually know what they're doing in this at the minute, but it seems like kitchen related. I haven't gone in deep enough to find out what's going on, but I do know sucralose took a 3% dip in 2020. That's simply because the pubs are shut. Sucralose is the post mix that goes into all the Coke and stuff that's on the bar. They're selling all the sugar to all the cola post mix, the lemonade post mix, and because that's all been closed, they've had this huge knock. But the primary products bit, which is 9% up year on year, is the bit that they're thinking about divesting, or at least a huge part of what they're trying to divest right now. So it's all going to be about how you value these sweeteners. It's saying it's trying to do it to get into healthier food. I wasn't sure that sweeteners were unhealthy food or seen as unhealthy food. That's something to think about. Quick little bit at the end here, we'll have a look at Genuine Impact. Genuine Impact rates Tate and Lyle as a high quality company and a cheap company, so there's a lot going for it there. But one thing that's really good about Genuine Impact and makes things really easy is that you can break down a company's revenue by sector, and here you can see that primary products makes up 61% of all of Tate and Lyle's revenue. 32% is in food and beverage solutions, their current growth part of their business, and obviously 5.6% is in their sucralose. So the sucralose bump didn't do that much damage. It's this beverage solutions that you really want to look at with Tate and Lyle. So if you're going to buy Tate and Lyle right now, you've got to realize that you're losing quite a significant amount of revenue and quite a significant stable part of the business that's going to be divested off into some other company. However, this food and beverage solutions, you want to figure out what that is, and you want to figure out how quick the growth is. Unfortunately, I'm not going to do that today because that sounds like a massive job. Analyst forecasts seem a little bit out here. I don't know what this thing is between 2023 and 2024. There's a lot to get into there, but let's have a look at just their historical growth rate. We've got 90% there. That's a bit of an anomaly as well, so let's bring that one down. And we can see that along the bottom here, the change on the year is 3%, 20%, 8%, 7%, minus 5% predicted in 2022, and then a growth of 12%. This is free cash flow, by the way. So on average, we can say that this probably, if you discount the 20% year, we can probably say that it grows at about 8%. Tate and Lyle is actually growing its free cash flow by about 8%. So let's go to the custom calculator. That is probably very generous for Tate and Lyle, to be honest with you. And let's do our best case scenario here, where we are looking at a PE of 17 in 2027 and also this 8% growth rate. And what we find is that this company, Tate and Lyle, is actually now 113% undervalued at 16% year on year rate of return. So that is in our best case scenario. So let's say that it doesn't grow at 8% year on year. That's pretty silly, I think. So let's put it down to 4% just to be as a normal sort of grade here. And I'm going to set it to a PE of 15 because it's going to take quite a while for it to get back up to a PE of 17. It's going to have to do something really, really good to get back up there. And in that case there, we've got a 9.28% return. That's a 44% capital appreciation over the next 5 years. That's actually pretty good. That's our 10% probably discounted cash flow style of return right there. That's only going to a PE of 15 as well, when we know that it does usually trade at a PE of 17. If it gets some really good news, it gets some really good momentum behind it, it actually could get this PE of 17, so it could go higher than that. Interesting. Worst possible case scenario, we'll set it to a growth rate of 0, and we'll set that PE at 12 in the worst case scenario. In this case, Tate and Lyle is overvalued. You will lose 12% of capital appreciation, but the dividend will save you and give you a total annual return of 1.4%. So the possibility of losing money on this stock is actually pretty low. And that potential upside with only a little bit of growth, that little 4% growth, you do have a chance of making that 10% return. So at these levels, from, this is just a 500-foot view. At these levels, actually, yes, Tate and Lyle might be a pretty good buy at this time. You've just got to learn a lot about the business, learn the different parts of this business, and learn how much Tate and Lyle is actually losing by spinning off the rest of its company, by spinning off the sweetener part of its company. It's a very interesting stock to look at. It was very interesting to break this one down, but it's not a very exciting company. It's not going to get you sort of 800% EV stock level of return right now, but there is a possibility of that 10% discounted cash flow return over the next 5, 6, 7 years. It's very possible. Let me know what you think in the comments below. Thank you very much for watching. If you enjoyed this video, please feel free to like, subscribe, and invest.